Hi, welcome to my new video. Today I will be talking about pre-year and last minute tax tips, and this can be very important for many of you if you are a higher rate or additional rate taxpayer, or if you're falling onto higher rate or additional rate taxpayer this year. So let's start. So mainly I'm talking about that tax-free childcare or 30 hours free childcare entertainment, high income child benefit charge, loss of personal allowances, if you're falling onto higher rate or additional rate tax bracket, pension annual charges, and capital gain tax, and how to save tax on all of this. So, if you are receiving 30 hours free childcare or tax-free childcare, it will stop if your income, your adjusted net income goes above £100,000. For example, if you want even £1 extra above that, or 1 pence extra above that, you will lose these thousands of pounds savings you are making using this tax-free childcare or 30 hours free childcare. Now, to keep your income below £100,000 and not really losing out, no one want to lose the income, so you can actually transfer some of the income to your future by putting the money onto pension, or you can help to the charities. I mean, some gifted donation that gonna reduce your adjusted net income, or check if you can defer some of the income to next year. For example, if you are a sole trader, or if you are a company director, and probably instead of taking the dividend in March, take the dividend after 6th of April. And in this way, you will be deferring some of the income to next tax year. So these are not the only ways. These are some of the most common ways you can save those taxes. Let's move on to high income child benefit charge. Again, if your income goes above £50,000 and if you receive child benefit, you need to start paying back this child benefit. And the way it works is between £50,000 and £60,000 for every your child. You need to pay back £1 for every £100 you earn above 50,000. As soon as your income goes above 60,000, you have to pay back every single penny of the child benefit. So again, that depends on adjusted net income, and to keep the adjusted net income below £50,000 is same steps as before: pension contribution, gifted donation, or try and defer some of the income to next year. There are many other ways as well. I mean, talk to your tax advisor, but these are the steps you can literally take now within next few days to before the year end. Very quick steps, and save the taxes. Loss of personal allowances. This is one. This happens to the people who earns above £100,000. When again adjusted net income goes above £100,000, you lose your tax-free personal allowances by £1 for every £2 that you earn above £100,000. And therefore, if you earn £125,000, or £140 or above, you will lose all of your personal allowances. And steps are simple. Your main key here is your adjusted net income. You need to keep it below that £100,000 to have those tax-free personal allowances. Next, move on to if you are falling onto higher rate or additional rate tax bracket. So as long as your income is below 50,270, you will pay only 20% tax. If it goes above that, you will be paying tax at 40%. If it goes above £150,000, you will be paying tax at 45%. Now, again, if you want to keep this below those thresholds, all you have to do is just pension contribution, gifted donation, defer some of the income, and you can keep and you can pay the tax at lower tax rate. I'm never saying these are the only few ways. There are many other ways. These are the only key ways that you can literally take the steps right now tomorrow, and just save those taxes before the year end. And pension annual allowance charge. You can contribute to a pension pot up to £40,000 every year, and that's gross. That's your gross contribution plus your employer contribution. And you have to put all of them together. If it's total above £40,000, you need to pay tax on any contribution above that. So it's not 40,000 for everyone. If your earning is above £240,000, it start to get tapered. It can be reduced up to £4,000, or if you have flexibly accessed your pension pot already, then again your annual allowance is £4,000. But let's say it's £40,000 for most of the people. You can actually roll forward, bring forward any unused allowances from previous 3 years as well. So first thing, check how much your pension contribution this year so far. Put and all of your gross contribution to all the pension pot, and also add your employer contribution, which is already gross. Don't cross it up again. And check if you have any unused allowances. For example, you added up all of your contribution and found it's £50,000, but from last year you got £10,000 unused allowances, so you will be fine. So bring forward all those annual allowances from previous 3 years and see what you can do. If you need to do something, probably you can contribute more during March, or you are already reaching 50. You used up all of your allowances, and so you can just stop contributing for this last month on March. Just don't pay anything. I mean, it depends on your situation, but there are steps you can take now to save the taxes. Let's talk about capital gain tax. If your gains are above £12,300, you need to pay capital gain tax on it. So the capital gain tax rates are 10% or 18% for basic rate taxpayer, or 28% or 28% for higher or additional rate taxpayer. Now, this £12,300, many people don't realize, is actually on top of your personal allowances of 12,570. So that's an additional exempt capital gain allowances. Capital gains you can have tax free. Now, potential ways to save is, for example, throughout the year you already made say £13,000 gains you have already made, so you already used up your exempt amounts. Now you are planning to sell some more share this month. What about if you don't sell it this month, sell it on 6th of April? In this way you are transferring these gains to next year. Or you can invest in EIS, SEIS, or VCTs. You can talk to a financial advisor and they can advise you on this, where to invest. And by doing those, you can actually defer your capital gain tax up to future years. And if you are very, very clever, you can actually draw all of these gains without paying any single penny capital gain tax using those investments. Or you can invest in ISA. Or you can transfer some of your investments to your spouse before you sell it. In this way, you each got £12,300 exempt amounts. So total you are up to £24,600 will be tax free. So that's one thing to think about. Or you can, if you got some investment which is outside ISA, you can use something called bed and ISA, and using that you can actually transfer your investment into an ISA. So that's another way. Capital gain tax it's a big area, and these are some of the small steps, but you can talk to your tax advisor or financial advisor, and they can really give you some good tips on this last minute tips. How if you are about to have some gains, so consult your tax advisor or financial advisor before you take any steps. And finally, thank you very much for watching this video. If you need any help or any advice, please find my contact details on the description below. Please like and share this video. That will encourage me to do more and more videos, and very, very soon my next videos will be on the EIS, SEIS, on all of the stuff, and how you can really save some money investing on those. So until then, thank you very much. Enjoy your time and save your tax. And remember, if you fail to plan, your plan will fail. So good luck.